Hello everybody and welcome to this new video entitled The Most Undervalued Growth Stocks in My Coverage Universe. And feel free to just look at the spreadsheet and figure out which stock you think are the most overvalued and undervalued based on the different metrics on this spreadsheet. A few things that are different on the spreadsheet compared to the last time. Like I said the last time, I've removed banking because I don't think companies like SoFi, for example, can be valued through that spreadsheet, so I've removed it from the spreadsheet. But I've added a few new stocks that you'll see that I have never put on this spreadsheet before. And if you're new to the channel, how do I assess whether a stock is overvalued or undervalued? How do I assess that? Well, I look at this metric called enterprise value over gross profit over revenue growth. And the higher that number is, the most quote-unquote overvalued, the more overvalued the stock is. So essentially, if you look at the spreadsheet, Shopify is essentially the most overvalued stock. Then you would have Tesla, then you would have AMD. AMD is actually more overvalued than Nvidia based on my spreadsheet. So why do I use this? Why do I use EV over gross profit over revenue growth? Well, because it's a spin on the PEG ratio. It's me modifying the PEG ratio for my style of investing, which is hyper growth investing. So I use revenue growth because I believe revenue growth is much better than earnings growth. Earnings growth can lie. Earnings growth, you can have different, accounting accruals. You can do buybacks. You can do a bunch of stuff to manipulate earnings growth. So earnings growth is not, in my view, a good proxy of product adoption. In my view, a good proxy of product adoption is revenue growth. And so using revenue growth, you have a better idea of whether a product is actually getting adopted or not. Then I use gross profit and not earnings, as in the PEG ratio, we use earnings. Why do I use gross profits? Because gross profits tend to be much more stable over time and they're much harder to manipulate, in my view. And I trust my companies because I've listened to the calls and I've followed them for years. So I trust the management of these companies to invest properly their funds after the gross profit line. The gross profit line tells me the economics of the business, tells me whether the business is highly profitable or not. But after that, I trust them to invest. So that's why I use gross profit. And then I use enterprise value because enterprise value penalizes companies that have a lot of debt. If a company has a lot of debt, it will be added to enterprise value and therefore this company will be more expensive. And so that's essentially the reason why I use this metric. And now let me tell you a little bit about each of these stocks, what I think about them, and whether I find them overvalued or undervalued, and what I'm doing with these stocks. So the first stock on the spreadsheet, and my first stock that I own is Tesla. Tesla is my biggest position. It's now well over a third of the portfolio, especially with a drop we've had. We've had almost $100 billion drop in market value compared to the peaks of the Christmas holiday. So we've had quite a bit of a drop, and I find the company to be a steal right now because let's face it, some of the reason why the stock has dropped are really not the fault of Tesla. Like the 10-day delay in the factory. That's not really the fault of Tesla. Pricing in China, that's the same issue every other month. Like literally every other month we have price adjustments and obviously whenever its price is up, it never gets reported. Whenever its price is down, it gets reported and it drops the stock. People are not happy with the way Tesla is pricing its vehicles, which is Tesla is pricing its vehicles to optimize volume. It's using sort of a yield management like for airlines, but it's doing it for cars. And so that's why it's changing the price all the time. But the media being what it is, that's how it handles this. And then you had a media campaign about Elon Musk's drug use, etc., etc., etc. This is one of the most criticized stock. And that's the only reason to me why the stock has dropped $95 billion in market value. That's the only reason. So anyways, the stock is still expensive if you look at traditional metric, but it's expensive. Why? Because I put 30% revenue growth in there, which is what analysts estimate. Over the long run, I think this company will do 50% revenue growth over the long run. And so if you were to put 50%, you'd find this stock to be cheaper, actually, to be much cheaper. And one last thing to say about this valuation, about any valuation really, is a question of can they sustain this valuation over the long run? This is a company, for example, that's trading at about 7 times sale. I see no reason to believe this stock could not be trading at 7 times sales in 2030. I see no reason. It would probably trade at that level in 2030 when we have rates dropping, right? When rates drop, it should probably still trading at 7. At a 7 price level in 2030. So in that case, if the ratio stays the same, then the stock goes up based on revenue growth. It's the revenue growth that gives the growth, and I think it's going to be 50%. And when I look at this stock, sure, we have a little bit of a slowdown with the car sales, but remember, that should be a good year, 2024, for car sales, because interest rates are going down. Right, but in Tesla we have divisions that are growing at 100%, like Tesla Energy. And Tesla Energy, Elon has said multiple times that Tesla Energy would be bigger than auto, and it's growing at 100%. And we have binary events coming up in Tesla. FSD could be a binary event. Optimus could be a binary event. These binary events can reset the value of the stock. This is a stock that tends to grow in value resets, where it will do a whole bunch of nothing for 4 years, 6 years, and then it will do a 7, 8x in a matter of 6 months. That's typically how this stock grows. And so, time in the market is more important than timing the market. Time in this stock, I think, is more important than timing this stock. The other company that I own, my second biggest position, is Enphase. Enphase is cheap again. We're in the 110s again, so that gives us a $15 billion enterprise value. Enphase turns solar panels into mini grids for your home. It's about turning your home into its own grid. It's about making those solar panels usable, because solar panels, of course, produce DC electricity, and your home uses AC electricity. And so it's developed this technology. It's pioneered the technology of microinverters. That's what Enphase does. We're the leader of microinverters. I've done many videos on the channel as to why I believe microinverters are the winning technology. They are the superior technology, in my view, over string inverters, at least for residential applications. And I like Enphase because it's the leader in residential, and residential solar. Based on what I can see, based on my estimates, residential solar has potential to be 10 times bigger than commercial solar. It's where the cheese is. It's like where all the money is residential solar. It's the bigger piece of the pie, and so Enphase is the leader in that. I've also made videos about Enphase, about how at $15 billion, that's likely lower than the present value of the subsidies they're going to get in the US for the IRA. The subsidies they're going to get in the US for the IRA are bigger than $15 billion. So this stock is trading lower than that. Let's remember, the IRA will be gone in 2035. Right? We have at least 10 good years of IRA. In front of us, of incentives in front of us. So, that's really long-term versus short-term. Short-term, the stock is down. They've had an inventory issue and interest rates are high. But long-term, in my view, solar adoption is just getting started. There will be a time where we take a walk in the neighborhood and every single roof will have solar panels on them. And that's why I invest for stock. I invest in product adoption. And the stock seems expensive. The only reason why it seems expensive is because I'm using the analyst's growth expectation at 12% over the long run. I think that growth rate will be much higher than 12%, probably closer to 30%, and therefore that would make the stock quite cheap. The last stock in the energy revolution stock segment, and why do I call it this energy revolution stock? Because, energy, these stocks are all revolutionizing energy. Granted, I could have put Tesla in AI too, but I put it in energy today. I call these energy revolution because we're seeing a shift in how energy is used and produced, and namely, we're going full electric. That's my belief. When I see the world, we are going full electric, and we're not going back, and these three stocks are right into this revolution, going full electric through EVs, electric vehicles, right? Going through full electric through the use of solar energy, the use of batteries, right sizing the grid, diminishing the size of the grid, removing natural gas, removing coal. This is a mega trend, and we are doing this not because of government wishes or support. No, the society is doing this because it's cheaper. Right? Society is adopting Teslas because Teslas cost $5 for 350 miles, $5 worth of electricity for 350 miles. That's not, gas cars is $50. That's why you're adopting a Tesla. That's the main reason. Economics is the main driver. So I just want to point that out. So STEM, what is STEM? STEM is an installer of Megapacks and Megapack-like systems. Okay, and so they're growing very fast at 85%. The problem with STEM is the gross margin. Now, I put it at 20% because I'm using the latest reports, but I'm being generous here at 20% gross margin. Some people, have said it's much, much, much lower. The idea of STEM is that they will install a lot of these mega packs and then they'll attach their software, which is called Athena. And their software has 80% gross margin, and that software over time should raise the price for a company like STEM. Okay, and STEM is cheap at a 0.07. All right, let me move on to my healthcare stocks. So my healthcare stocks are HIMSS, Transmedics, and Shockwave Medical. So HIMSS, and by the way, that's rounded to 3 digits, but that's 0.04. HIMSS is the cheapest stock that I've ever seen. It's the cheapest stock in my spreadsheet. It's an amazing stock. I don't understand why it's so cheap. It's still cheap, even if it's $8 now-ish. Right, it's still cheap. 0.04. This is, in my view, really unheard of. What is HIMSS? HIMSS is a direct-to-consumer an e-doctor, e-pharmacy without insurance. Direct-to-consumer e-doctor, e-pharmacy without insurance. That's what HIMSS is. It's the idea you want a treatment with HIMSS. You want to be treated for something like hair loss, and you want a prescription drug. You go on the website. You see a provider on the website, and then the provider either prescribes or prescribes not to you, and if they prescribe to you, then it's the HIMSS e-pharmacy that will fulfill the pharmacy, and they own everything, and of course they do not accept insurance, and the reason why they do not accept insurance, in my view, is because they're able to grow much faster. They're able to roll out custom products, like their custom weight loss products recently that they rolled out. They're able to roll this out much faster because they don't have to deal with reimbursement and they don't have to deal with paperwork. They have, they're light. They're HR light, right? They have very few employees. They use automated warehouses. So anyways, because of that, a company like HIMSS is growing at 60% revenue growth for the next 12 months, at least what analysts say. And it's more than 90% recurring revenue, and the gross margin is 81%. So it's really, really outstanding, and they just became EBITDA profitable if you're into that. So I love this company, very much happy to own it. A stock that I've covered on the channel before, that I haven't bought yet, but I'm seeking to buy, and I'm changing my tune on this company. It's called Transmedics. Transmedics is an organ transplant system, a live organ care system, OCS is how they call it, organ care system, that allows you to improve your outcomes in organ transplants compared to dry ice. So they have this device, this big medical cart in a way, that if you're in an organ donor situation, it expands the life of the organ and it makes the organ much more easy to transfer. So it's kind of a 0-to-1 innovation in that space. One thing that doesn't lie when you look at Transmedics is revenue growth. Predicted revenue growth for the next 12 months is 122%. That's unheard of. That's the highest in this whole spreadsheet. 122%. At this level, these numbers don't mean much anymore. Okay, the base is low at 192 million, but it's not. I mean, it's not that low. 192 million is not that low. It's growing at 122% of that base is still very, very impressive. Gross margin is 66%. That will go up as they recently acquired an airline, and so they'll be able to do their own fulfillment and their own shipping. Anyways, the stock is cheap at a 0.18. It's in the first quartile cheap of my spreadsheet. So I like the stock very much. Another one that I like is SWAV Medical. So SWAV Medical is what they call lithotripsy. It's a shockwave catheter that allows you to break calcium deposits in your arteries. That's essentially the business. It's an innovation compared to the old way of doing this in the medical space, because the old way of doing this in medical space was typically to blow a tiny balloon in your arteries in order to pop calcium. And why do we care about this? Because heart disease is the number one, is atherosclerosis more specifically, is the number one cause of death in America and likely the world, in my view, or at least the Western world. And actually almost 20% of cases of heart disease also have calcium deposits in arteries that need to be taken care of. And that's what this business is going after. If you look at SWAV Medical, growth is predicted to be 57%, which is outstanding, and the forward gross margin for this company is 87%. Now, whenever we get close to 90% gross margin, wow, you have an outstanding business. That right there is an outstanding business. The stock is cheap in the first quartile of my cheap stocks at 0.23. So it's a cheap company. All right, let me move on to my data warehouse and data monitoring stocks, and we are in expensive land right there. So you have Datadog. Datadog is data monitoring. It's a stock that allows you to monitor all of your applications, all of your IT stack, all of your SaaS, everything. Modern enterprises have a bunch of apps that talk to each other. Whenever there is a problem, it may be very hard to find where the problem is. That's where DDoG comes in. DDoG allows you to detect problems in your applications and go solve those problems. So it is a form of a big data system in the sense that it analyzes your entire IT. DDoG is the cheapest stock out of all of those, out of all of the data stocks, quote unquote. That's the cheapest stock at a 0.66. I would argue that's close to a bargain compared to the other stocks in the spreadsheet, because of course these stocks are SaaS, right? So they all have recurring revenue. But you see DDoG has very good gross margin at 80%. And as far as I'm concerned, they are the number one in what they do. As far as I'm concerned, they're a leader in their field. I own Datadog. I'm very happy to own it. Snowflake, I don't own anymore. I sold it based on the 180 that they did on their guidance more than a year ago. I was very disappointed. This was a stock who had repeatedly told it would grow at 80+%, and then overnight they said, "Oh, we're just going to grow 40%." Typically, it's a red flag for me when a CEO does that. As praised as their CEO is, right, it's still a red flag to me when a CEO does that. Snowflake is the leader in columnar database, not document database, but SQL databases, and it allows you to store your data in the cloud and actually query your data in the cloud, not have to store it on premises or with the offerings of the cloud providers, right? You don't have to use the offering of the cloud providers. You don't have to use the offerings on-prem, right? You don't have to do it on-prem. You can just do it on Snowflake. Very interesting billing system that they have too, but the stock is too expensive for me. Another stock that I find too expensive. I found it too expensive for a while. I keep finding it too expensive. It is Palantir. Palantir, to me, I mean, the growth is just predicted to be 20%. That's that's very low in my view, especially when we have AI companies. You'll see later when we talk about, say, Nvidia, when we have companies growing much faster than that. You look at a company like Palantir. I'm not too sold on growth. Also, 20% is nothing like what they had guided. They had guided 30% over the long run. It's been a few years now where we get 20% and less than 20% growth. The stock, I believe. No, I don't believe. I see that the stock is up recently. But in my view, the stock has been up mostly because of a military business. Anyways, I still own the stock. I still have about half of my original position. I've always owned it for the military business because they have a monopoly in the military business. The commercial business for them is doing a little bit better. So we'll see. But this stock is almost a 1 on my spreadsheet. So that is expensive. And we'll see what happens. If Tesla keeps dropping, or yes, I don't know, if we have like a major drawdown in a stock that I like HIMS or StoneCo, as you'll see in a second, that's a stock that I might liquidate and might sell it. So anyways, we'll see how that goes. MongoDB is somewhat of a competitor to Snowflake, but not entirely, because they focus on NoSQL databases. What they do is they have document databases where each data point is a file, and you store data line, I should say, data. Each line of data is a file. Instead, what you would store in a spreadsheet in the form of a line, right, of a row. When it comes to document databases, you store it in a file, and that's what they are. They are document databases, which is another approach to databases, which a lot of coders are very into. And they are the leader in their field. The only issue that I have with this stock, of course, is that it's expensive. But again, I own the stock. I don't plan on selling it. I'm happy to own it. But these stocks, one candidate for me for selling these companies is Palantir. Definitely Palantir I find a little expensive right now. Moving on to my cybersecurity companies. So my cybersecurity companies are Crowdstrike, Zscaler, and Cloudflare Net. Let me briefly discuss Cloudflare. I have sold Cloudflare when it was much more expensive relative to Crowdstrike and Zscaler. I'm happy to have sold it. I'm happy to have sold it then. Cloudflare is a stock that used to have a valuation premium compared to the other SaaS companies. It doesn't anymore. It doesn't anymore. And so today, if I were a new buyer of these companies, I probably would consider Cloudflare. But Cloudflare, what they do is they are essentially an antivirus for website or a firewall for websites. They protect websites from attacks. If you have a big company website, you can get DDoS attacks. Cloudflare as a network of proxied servers, if that makes some sense, and they hide your IP to potential attackers. That's essentially the business. And then the two businesses that I like and that I like to buy hand in hand, it's Crowdstrike and Zscaler. To me, these businesses go hand in hand. Crowdstrike is the leader in quote-unquote antivirus. What they have is that they have this very large network of computers, and they install the Falcon software. It's the name of their software, Falcon. They have it installed on so many endpoint devices. And whenever there is a breach on one of these devices, the software updates and the breach is fixed. And so the hundreds of millions of devices that have the Falcon software get the update live. That's why we call this a cloud antivirus or cloud security system. And by virtue of that, it is the biggest in the space, which is why I believe it will win, because for cybersecurity, you want to have the best solution. It's you don't have a choice. You want to have the best insurance against issues happening to you, and Crowdstrike is the best. As far as I can tell, we also have great long-term guidance for Crowdstrike. It's a stock that I'm happy to own. And the stock that I own in conjunction with Crowdstrike is Zscaler. So Zscaler is what we call a zero trust security system. So it allows, let's assume CrowdStrike fails and your computer gets infected. Well, with Zscaler, your computer can't affect the rest of the network, can't affect the rest of your cloud, your servers, your apps. It can't affect it because it isolates each device, and no device is trusted. There is no such thing as getting on the network, and once you're trusted on the network, you can change anything. With zero trust system, like what Zscaler pioneered, each device needs to be a trusted device, such that if your computer is infected, it won't infect other computers. And that's what Zscaler does. It essentially provides a secure connection between all of your devices. And oftentimes, these two software are provided hand in hand and sold hand in hand. So that's very interesting to me. And of course, cybersecurity is a mega trend. I believe it will remain a mega trend for the next 10 years. And I'm happy to own it and invest in the product adoption for these companies. E-commerce is the most advanced megatrend, right? I mean, in some countries we're at near 60% adoption. If you look at the US or at China, you're at the 60-ish% adoption of e-commerce. In other countries, you're not there. Like in Latin America is still early as far as e-commerce go, and that's why I own a stock like MercadoLibre. MercadoLibre is the leader in Latin America. MercadoLibre is cheap. It's in the first tier cheapest stock in my universe, in my coverage universe. So this is cheap. MercadoLibre is the leader in Brazil, but not only in Brazil. They're doing very well in Venezuela. They're doing well in Mexico. They're doing well in all of the Latin America countries that they are in. And it's an e-commerce website. It's an e-commerce platform that's far ahead Amazon in these regions. And just like Amazon, they have their own fulfillment network and they have their own payment division, not like Amazon, right? But they have their own payment division, and they also have an advertising division. It's a very complete business. They have everything but the cloud. So think of it as an Amazon without the cloud. This is how I would think of it. So MercadoLibre, very interesting company in my view. And cheap right now, very cheap. Let's talk about C Limited. C Limited is spelled SEA in the name. It stands for Southeast Asia. It's the e-commerce giant of Southeast Asia, and by Southeast Asia you should understand mostly Indonesia, or at least Indonesia as the biggest market. Just like for MercadoLibre, the biggest market in Brazil. For C Limited, it's Indonesia. This is a company that's growing at 13%. The reason for that is the video gaming division, who saw its game banned in India, but the game has been authorized again. So we should stop bleeding money, quote unquote, from gamers who can't play that game anymore. And so that gaming division should not be a drag on the e-commerce division. If you look at the e-commerce division of C Limited, it actually grows at a pace that's very similar to MercadoLibre. C Limited, just like MercadoLibre, is two businesses in one. If I may say it like that, it's e-commerce, and it's a C Money, which is their digital wallet, their digital banking offering, and then we have also the gaming division. But the gaming division is what the business has been hurting from. One of the reasons what makes me bullish for C Limited is that the company has decided to reinvest in itself and to reinvest in its growth. They had made the mistake of stopping investing in the growth to satisfy Wall Street and show earnings. And now they have earnings. You'd think the stock would be back to the level that it was. You'd think the stock would be back up right now that they're showing earnings like Wall Street asked. Well, guess what? Not at all. So the CEO did a 180 one again, and now is focusing on growth. And I don't think he will make that mistake again to sacrifice growth for earnings because Wall Street's short term. I don't think he will make that mistake again. I've actually been buying that stock recently, because I believe this is a type of stock, if you have a turnaround in the growth rate, you could easily see a re-rating of the price in the market quickly. So I'm happy to own that stock in the e-commerce space. My biggest e-commerce position is MercadoLibre. The last stock is Shopify. I used to own Shopify. I sold Shopify. Shopify is extremely expensive at a 1.41. And frankly, this is a pattern that I've noticed with tons of Canadian stocks. Canadian stocks are expensive. I don't know why, but they are expensive. So the main reason why I don't want to own a Shopify is because it's expensive. Quite simply, the growth is not there compared to all of these companies out there at 22%. It's not very high growth. And Shopify, what does Shopify do? Well, they operate websites for big brands, right? They're the leader operator of e-commerce for big brands, and they do just about everything for big brand. They've got empires built on top of Shopify. If you look at the Kim Kardashian sales empire, it's built on Shopify. If you look at Figs, for example, Figs, which is a clothing brand, but we'll get to later, Figs is operated by Shopify. The website is operated by Shopify. If you look at Tesla's, Tesla gifts and goodies, like all of the Tesla gifts and goodies website is operated by Shopify. They operate this side of the website for Tesla, and it's a big business for Tesla. And it's not just gifts and goodies; it's also things like chargers and connectors. They cover this for Tesla, so they operate these websites for a large major brand. They're kind of an e-commerce operating system. Great business. Wish the valuation was not this high. But then again, valuations can remain high for a very long time. So moving on to my payments, and this is where I have a lot of change. I have a lot of change in my payments division here. A lot of additions, not change. I have namely, I have 3 additions here. So let me get started. So first of all, Dlocal is a company that I've sold out of. Dlocal has been under attack relentlessly by short sellers. That has become annoying because, the fundamentals of this company, they can't be properly analyzed whenever you have a short seller attacking the stock and claiming things. It's I don't know why the short seller I've gone after Dlocal. It's a stock that I really used to like. I like the numbers, I like the growth, I like the gross margin. But when you own Dlocal, in my view, you have a risk over a 1 year period. Are you going to get one more short report? And if you get a short report over a one year period, then it's a 50% drawdown in the stock, and it's happened multiple times for Dlocal. So that's a stock that I don't own anymore, which is too bad. And I wish the short sellers would stop. And would stop attacking this company. Short sellers, for some reason, love to attack payments companies. I don't know why. You may remember Square. Square was also attacked by a short seller, right? Saying that it was used for a whole bunch of illicit activities. Moving on, StoneCo. So StoneCo is my favorite company out of all of those. My favorite. Love StoneCo. First of all, it's growing very fast at 41%. But if you look at the gross margin is much higher than any of them. Gross margin is much higher than any of the payment stocks. So actually, my spreadsheet is going to advantage a company like StoneCo, even though it even though it has the third fastest growing revenue line, the gross margin is so high that, if that makes sense, I'd rather own a StoneCo with 41% revenue growth next 12 months and 74% gross margin than, say, a Taost with 42% revenue growth, so a little better, but only 21% gross margin next 12 months. I'd much rather own a StoneCo. And that's the reason why this stock is so cheap at 0.08. It's the second cheapest stock after HIMS, second cheapest. And what they do is they do payment terminals for small businesses in Brazil. And Brazil, they have about 3 million small businesses that use their payment terminals. Brazil is an economy that has a lot of small and medium-sized businesses, which is why the business is taking off. They also have a division for micro sellers and micro entrepreneurs, which is something that we don't really see much in the West. But people making, let's say less than $1,000 a month in revenue that use the app. They would use the Stone app to run their business, and they're getting into so many different divisions. I'm very happy to own StoneCo. I believe this company used to be a darling of Wall Street. They've had an issue in 2021 with their collateral. They lost about $500 million in a collateral business and in a collateral issue. And the stock dropped by 10 times. Like, it lost 90% of its value, and it's barely up since. It's been dismissed by Wall Street. Yet it's a stock that's still owned by Warren Buffett and Cathie Wood. Warren Buffett and Cathie Wood own this stock. Always worth mentioning that. Very interesting, I think. Taost. I've just covered Taost on the channel. Taost is the leader for restaurant payments in the US. I've never met a server who doesn't praise Taost and say, "Oh, I love this thing. Oh, I love Taost. Oh, Taost is the best." It's heavily loved in the restaurant industry. They love the company. There's a lot of competition in that space, of course. But if you look at Taost, revenue growth is great at 42%. Gross margin is, in my view, awful for a payment business at 21%. The business of Taost is a little similar to the business of Stem in the sense that it's a really hardware-heavy business in the beginning, where you have to subsidize a lot of hardware. But over time, as restaurants get the hardware, over time, the gross margin should go up, because we only have to get the hardware once, and then the gross margin goes up, if that makes some sense, because the share of your sales is mostly processing payments, and the share of your sale is not the hardware anymore. So this is a company that should see gross margin go up, but the question is, when gross margin go up, will we see revenue growth go down? Anyways, I did not pull the trigger on this stock, but I understand if you have affinity with restaurant business, if you see it everywhere, if you go out a lot, you may have insights that I don't have, right? You may see this business from a different light, right? If you work in the restaurant industry, there's a lot of investor profiles where it would make sense that you would choose a stock like Taost, for example, because you have an affinity with the business. PayPal. So PayPal, I've actually started a teeny tiny position on PayPal. And you're like, why did I do that? I mean, it goes against everything I believe in because of the growth. Look at the growth, 8%. And it would surprise people. First of all, it's never going to be a big position. It's in my he must play portfolio. That's the portfolio that it's in. The reason why I've started a position with PayPal is because I believe they have a shot at gaining quite a bit of market share with crypto and crypto purchases, because they allow you to purchase a bunch of crypto. And I think we're going to go into a bull run. So that could greatly benefit PayPal over the medium term, and also buy now, pay later. They're often forgotten, but they have a buy now, pay later. And in fact, whenever I see websites now, I see very often PayPal as a payment option and as a buy now, pay later option. So they are everywhere. They are worldwide. And that's why I'm taking a gamble on this company for the E must do something portfolio. It's very uncommon for me to invest in a company that has only 8% growth, but let's face it, 8%, you're still a little higher than the growth of the economy. So it's I think it's still no investment advice, right? But I think it's still a hell of a lot better than an index fund, if you ask me. So I own it. We'll see where that goes. I just don't think there's much downside in the stock anyways. So worse for worse, it's a savings account. Square. Let's talk about Square. So Square is a stock that I used to own. I don't own it anymore. Why do I not own it anymore? Because the growth, in my view, is not there anymore, and also the valuation at 0.47. When I sold it, it was actually higher than that. But that valuation I could not justify compared to a StoneCo, right? It's tough for me to justify owning a Square when I look at StoneCo and StoneCo's number. That makes sense. Okay, Square has a little bit of a different business, which is the Cash App, right? And the Cash App is to me, the Cash App is closer to a competitor to SoFi, which I won't cover in this spreadsheet. But I look at Cash App as a major business, and when I look at a business like like Square, to me, the bunch of evaluation in Square comes from what Cash App could be and could become. And Cash App is the leading payment wallet in the USA. So. But anyways, I still don't own it. One thing that would keep me up at night a little bit, looking at a company like both PayPal, which I own just a tiny portion of, and Square, the one thing that would keep me up at night is X.com rolling out payments and payment systems, rolling them out within the next year is what Elon Musk has stated. And so if X rolls out payment system, right, it's not a threat this year, or not a threat even next year. But, I wonder, 2026, 2027, could this be a threat to these peer-to-peer payment systems, to these apps? Could this be a threat? And it would be a bigger threat to PayPal and Square than, say, to Taost or StoneCo, because Taost and StoneCo are all about small business, and they have a small business specific offering. But if I look at a PayPal or a Square, I'm like, okay, PayPal has a big Venmo business. It's still stuck onto Square, but that could be directly threatened. The Venmo digital wallet could be directly threatened by, say, an X digital wallet, and same for Square with the Cash App. So I'm careful. We'll see. I mean, that maybe that's an unwarranted thing, but it's always something to keep on the horizon that this is coming. Okay, let me move on to my chip makers. So the chip makers, are so essential to the AI revolution that we are going through. Let me get Indie out of the way. Indie is a teeny tiny holding for me, not even worth mentioning really. It's the Must Do Something portfolio. Indie is cheap, 92% revenue growth predicted. Gross margin is not that good at 25%. Their gross margin actually went down, and if you look at their EBITDA margin, it's well into the negative. So that's a risky company right there. In my view, that's a risky company. They cater semiconductors. They offer semiconductors to the auto sector, specifically the competitors of Tesla in the auto sector, which may make it even more of a hard sell. So the way I look at it is I'm a little concerned about this one. It's in my He Must Do Something portfolio, but if I'm not gonna sell it, but I'm not adding at this level, and if it goes to zero, then be it. It's a tax write-off. But yeah, not because if I look at their customers, which are the BMWs of the world, that's their customers. If I look at their customers, yeah, their EVs are not getting adopted. No, it's not happening. Especially the more Tesla keeps dropping prices, the less the adoption I see. Volkswagen, do I see a lot of adoption in that? Not at all. Not at all. And even the other EV makers, like pure play EV makers, are in deep trouble. Look at Lucid, they're in deep trouble. Look at Fiskars, deep trouble. So you can make an argument that Rivian is going to be okay. But even when I look at Rivian, I'm like, thank goodness that Rivian has that Amazon backing. So really, yeah, my eggs are in Tesla. Everything is in Tesla for me. So careful about that one, I would say. And then you have AMD and Nvidia. Believe it or not, when I look at my spreadsheet and when I use my EV over gross profit over revenue growth, my spin on the PEG ratio, I find that Nvidia is actually cheaper than AMD and cheaper than most think. I mean, Nvidia is cheaper than a lot of people think, which is which is crazy to me because Nvidia is always covered as this extremely overpriced company. I'm not so sure. I don't know. Like when you look at the size of this market, when you look at the 10 years out prediction, could this be a $300 to $400 billion a year market? These AI chips, could they be $300 to $400 billion in market size by 2030? Which, if you look at the estimates, that's what a lot of people say. And then assuming Nvidia has 80% market share, we're looking at revenue figures that are much higher than this, much higher than 44 billion in revenue. And so the growth has been explosive, and I think it may continue to be explosive. So I don't own it. I sold it for a nice profit, and that was a mistake. I shouldn't have sold it for a profit. I guarantee you this, I'm not making this mistake with Tesla. In another, vein, I'm not making this mistake again with Bitcoin. I don't cover Bitcoin in this video, but if you know the channel, I don't own bonds. My bond alternative is Bitcoin. I have 0 bonds, but what I would have in bonds, I have in Bitcoin. You may know this. Well, I'm not selling Bitcoin because I made that mistake once, and you don't make that mistake twice. So maybe it was a mistake to sell Nvidia. And if I get back in, I can tell you one thing is I'm not gonna sell it. I'm not gonna sell it because Nvidia is a special company. I believe they're much more proven than, say, a Palantir, for example. And then you have AMD. AMD looks to be the second player in this AI revolution. A lot of people are buying AMD because they think AMD is cheap. Yeah, I agree. Not on my spreadsheet, but if you look at absolute numbers, AMD is much cheaper. Like if you look at a price to sales for AMD compared to the price to sales for Nvidia, you realize that Nvidia is more than 3 times more expensive on a price to sales basis than AMD. But it's not about just the sales, right? It's about the revenue growth. And so we'll see. They've introduced new products at AMD that may take a big share of that Nvidia. What I find interesting when you follow these stocks, which I wish I had more time to follow them, but what I find interesting is that there is a little bit of fungibility between the AMD GPUs and the Nvidia GPUs, in the sense that companies will buy AMD GPUs for their lower intensity tasks, and then they'll save the Nvidia GPUs for their most high-intensity tasks, such that Nvidia GPUs used to be used for everything, and now they're not used for everything anymore. They're only used for the most advanced task. The less advanced task can do just fine on AMD, and it seems to be one of the drivers of sales of AMD. Anyways, we'll see. I think we'll have more clarity on both of these companies as we get more quarters and more quarterly earnings presentations and earnings calls, etc. Let me move on to lifestyle, my lifestyle stocks. I've added Celcius in there. Celcius I covered recently on the channel. Celcius is an energy drink that has the potential to disrupt Monster and Red Bull and soda and, soda as a whole. And, help, not help, but really coffee. The story of energy drinks has been that of coffee disruption, in my view, because if you have a Celcius in the morning, you're not going to have coffee in the morning. And Celcius tends to be this only drink that I would argue is almost socially acceptable to have in the morning. Like I would not see, if you're on a road trip, you're at a gas station at 7 a.m. I don't see a lot of people picking up a Monster at 7 a.m. But I see people picking up Celcius at 7 a.m. So you have innovation in the sense that this is a beverage that people seem to consume at every single time of day. It's a beverage that tends to be much more gender neutral in their marketing, in their appeal, such that it's actually very popular among women, compared to all of the other energy drinks that are less popular among women. And if you look at the marketing of Red Bull, or you look at the marketing of Monster, it's not a all-inclusive marketing, I would argue. And also it caters to all sorts of ages. Celsius tends to be, and it focuses on health. It focuses on health, right? Some of these energy drinks are infamous for getting you close to the heart attack level. Not Celsius. They try to put that health forward. So So we'll see. They have an interesting positioning. Lifestyle brands, there's a lot of marketing going on in lifestyle brands. So this is one of the reasons why I have to talk about marketing. But new generations mean new brands, and could Celcius be one of these new brands? I think it's possible, because look at how fast they're growing. They're growing at 79% next 12 months. 79% predicted revenue growth over the next 12 months. That's just insane. And the gross margin is excellent. And they have more going for them. Like they have the Pepsi partnership. Pepsi's handling their distribution. And, another thing that I think is amazing for Celcius is that they're not in Europe. Europe is a market of people, right? As far as people go, there's 50% more people in Europe than there are in the US. And Celcius is not in Europe. When I go to Europe, Red Bull's everywhere. Monster is everywhere. Celcius is nowhere to be seen. So that means they have another doubling there if they go to Europe. And when I see, I was in France over the holidays. When I see how American brands, American companies are like super, super popular over there, I'm like, hey, the new fancy American energy drink coming to Europe, people are gonna buy that stuff. That's just what I see. So, anyways, I'm looking to get back in. This is the first tier cheapest. This is in the first tier cheapest stock in my universe, despite what would seem like a nosebleed price to sales. So I'm very confident about this company, and I might get back in. This is yet another one of these companies that I bought. And I had a profit, and I sold it, and I shouldn't have. So we're learning. We are learning. I am learning, at least. Lovesac is a teeny tiny meaningless position. It's a stock whose price dropped tremendously. Why? Because interest rates up, so people never ever buying furniture ever again, says Mr. Market. I don't think it's the case. It's a modern furniture brand. They compete against, say, recliners, but they have bean bags instead of recliners. And it's always funny. You see this lazy boy recliner, and it seems very complicated to make. There's a mechanism. There's pieces of wood. There's cushions. There's fabric, and they charge what, $1,500. And then Lovesac comes around, and they invent this bean bag, which is just a little bit of foam and a cover, essentially. I mean, I'm exaggerating, but essentially what it is. And it's also $1,600. And so you have a company that has an insane gross margin. You have a company that has a product that's very easy to ship. And then you have another company who doesn't have any of that, because it was built in the 20th century, and Lovesac is a company built for the 21st century. And it's dirt cheap. To be honest, the appeal for a company like a Lovesac, and by the way, it's the E Must Do Something portfolio. That's where it's at. It's nowhere else. The appeal is the valuation at this price. I just don't think that's much risk at this price. No financial advice, but still. Figs. What about Figs? Figs is a similar story to all of these two, in the sense that it's a story mostly about marketing and about new brands. Figs is trying to make scrubs, clothing in the medical sector. They're trying to make it mainstream. They're trying to turn it into something that you would wear on a Sunday, or that you would wear gardening or whatever. Scrubs, based on what I hear, I've never worn them, but they tend to be very comfortable work clothing, and they want to take that idea and make it mainstream. And it's a little bit like what Lululemon did for the yoga pants, right? Yoga pants used to be this specialized piece of clothing that you would only wear in the yoga studio, and now they've become mainstream. Could Figs pull off the same thing? Could they pull off the same thing with scrubs, right? Could they do and in the early days, that was the story of Levi's, right? Levi's invented this clothing that was more for blue collar type of clothing, for workers, initially in the mines. And then what happened? The piece of clothing went mainstream, and Levi's became very big because that piece of clothing went mainstream. And so we've seen that pattern in clothing over and over and over again, right? Something that was confidential, not used by everybody, and then becomes mainstream. And so we'll see. They could pull it off. I think it's worth noting it's in the first quartile, cheapest stock in my universe at a 0.17. Very cheap. The growth has stalled a little bit. Now it's predicted at 13%. It's very obvious why the growth has stalled to 13%. It's because we've had a surge, right? We've had a surge in healthcare demand in 2020 and 2021 and remnants of it in 2022. So that surge means that doctors and nurses are equipped, but these clothings don't last forever. Especially if you wear them all the time, they don't last forever. You need to replace them, and I believe that growth will come back. It's worth noting that be it Figs or Tesla, they're both owned by Ron Baron, both of them, which I love very much, because Ron Baron is in my view, an outstanding investor, and he's behind both of these companies. And in the case of Figs, he says he owns the maximum he can own for Figs, right? Because he's a fund manager, and so there's limits to how much he can own. Anyways, these were my lifestyle stock. Let me now move on to the cloud niche stock. I will mention I don't own any of these stocks anymore. The reason why I don't own it is because I think their growth will be constrained because of all of the heavy hardware investments that they have to make. And being in that space, being in the they are in the software space, or in the hardware, in the running software for others, or running their own software on hardware. When I look at data, when I look at applications, when I look at modern day businesses, it's clear to me that the faster growth comes from running the software and not necessarily from operating the hardware. And when you're in a cloud business, you operate the hardware, which this is why, for example, Amazon. Some people say it's a wonderful thing that they own AWS. I say I'm not so sure. Maybe I like the e-commerce better because even though AWS is very profitable, it's only a matter of time until Amazon makes its e-commerce division very profitable, right? It only takes the end of brick and mortar retail, and if it ends, then Amazon, you bet, will be very profitable. It will raise prices. So DigitalOcean, briefly, DigitalOcean focuses on small business, focuses on very small business, focuses on developers, and it offers a cloud solution for developers of small websites and small cloud applications for small business. So it's got that niche. So it's definitely not competing head-to-head against Google and against Microsoft and against Amazon. It's not. And if you look at the average spend on DigitalOcean service, it's about $50 a month is the average spend. So it's really the cloud for very small businesses. And Axon, you may be surprised that I put Axon in the cloud niche. The reason why I put Axon in the cloud niche is because if you look at their two other segments, which are self-defense and cameras, digital cameras for police officers, the first two are mature. They're mature in the US, in my view, and Europe has been reluctant to adopt these systems. So the first two waves of growth of this business are mature. They have the third wave now, which is management of evidence online, management of camera records for police departments, management of all of that online, and that's where the next wave of growth is coming in the business. It's very interesting that they've been able to find new growth, and so if you've owned it from the beginning, and if you have high capital gains in this stock, I would keep this stock. But me, I owned it late, and so I sold it, and I look at my other companies compound, and it won't be this one. But it's nonetheless cloud niche. I've covered it before. I might cover it again. The last two stocks that I own are Xometry and Airbnb. They're platforms. I've been caught saying before that platforms are one of my favorite type of business models for many reasons. One of them is you don't actually produce the product. You just facilitate the transaction. So in this way, it's very similar to payments companies who don't produce anything. They just facilitate transactions. For platforms, it's the same way. They just facilitate transactions. But platforms have this advantage that they have network effects, such that you're going to be tempted to go on the platform that has the most people on it. You're not going to want to go. It's like a dating site, right? You could have the best dating site in the world. If it only has 2 people in your city, you're not going to go to that dating site. You're going to go to the dating site that has the most people. The same is true for just about everything, right? You're going to buy the phone that has the most apps. That was the story of the iPhone back in the early days. And you're going to go to the website that has the most accommodation possible. That would be Airbnb. And you're going to go to the website that has the most CNC designers, casters, molders, industrial fabricators, you're going to go to the website that has most of those, and that's Xometry. So let's finish this video with Xometry and Airbnb. Xometry is in the first quartile, cheapest in my spreadsheet. I like Xometry at these levels. I think it's a cheap stock. And Xometry focuses on the design and manufacturing of small batch parts. So, for example, CNC machine is a big part of their business. You say you have engineers in a development center, they want to have a part done. They would contact a shop in the past and get an estimate and then get the part done. Now they can use Xometry and give a part to Xometry, and you have all of these machining shops that are registered to Xometry who will be able to do the business and deliver the business based on the different requirements of companies. And it's a business that's growing pretty fast at 39% revenue growth, 38% gross margin, and I think in my view they don't have competitors. In my view, this is a clear disruption in that space, very niche, but plays very well within the trend of manufacturing coming back to the West. And it's a stock that I'm looking to own. I don't own it yet. Last stock that I own is Airbnb. Airbnb is that for accommodations. For every 10 hotel rooms, you only have one Airbnb booked, so there's a lot of growth built in. The problem with Airbnb is that the growth right now at 22% is a little low, but we'll see how it goes over the next few years and what place travel will take over the next few years. Airbnb, what I like very much about their offering is that obviously they are doing very well with accommodation. They're a low-cost product if you travel more than 3 people, right? If you travel as a family, Airbnb is often a low-cost option. They're a reflex for Gen Z. Gen Z look at Airbnb first. They think of this before hotels, and before hotels they look at Airbnbs. So that's a big deal right there. And I'm very optimistic about them getting into disrupting the mom and pop rental business, where you have Airbnb, which could disrupt the mom and pop rental business in the sense that 20% of the bookings on Airbnb are 1 month or longer. And the question is, how much longer are these bookings going to be going forward? It's heavily used in things like, international students, for example. Very tough for an international student to get a lease. Very easy to just live on Airbnb for 4 months, the length of your semester. So a lot of them do that. It's got innovation. It's created a layer of trust. I've covered Airbnb multiple times on this channel. So I'm not going to spend too much time covering it. And you can see my averages, right? So the average is right at around 0.5, the average on my number. So obviously the average stock that I select is very attractive in my spreadsheet and in my view, because keep in mind there's a bunch of stocks that I don't put on there. But that I see promoted all the time, that have a 3, a 4 on this. Plenty of stock have a 3 or a 4 on this. So to me, the average, if I were to do an equal weight portfolio on those average and I get a 0.54, I'm very happy with that number. Anyways, these are all of the stocks that you can expect to see covered on this channel. If you follow the channel, some stocks I cover every 4 months, others I cover every 6 months, others I cover maybe every 2 weeks, like a HIMS or a Tesla, for example. So it all depends which stock you like or not. Anyways, this was a comprehensive video. I hope you enjoyed it. Thank you so much for watching. This is not investment advice. This is not financial advice. This is just entertainment. Please like. Please subscribe, really helps me out. It takes me a while to do these videos and update these spreadsheets. No financial advice. Thanks for watching. Have a wonderful, wonderful day.